be something that, I don't know, I guess would tell me if we're live, but it's not. I just looked at it, so more from convenience or habit than anything. Thank you for tonight. I'm joined by Rob behind the keys. Rob's joining me from the office tonight. He's putting in the hours. So thanks, Rob, for taking some time out on your Wednesday night, putting in the extra yards. It doesn't go unnoticed, and especially now that I've mentioned it, hopefully everyone at Selfwealth will know that how hard you're working. So wink to you, mate. Now you know, you get it. If you can hear me on the live chat, please say g'day. Jump into the live chat. Say hi, Owen. I can hear you. Hey, g'day, Rob. Thanks for being with us. I can see a few of you are online already, so please say hello so I can hear you and you can hear me, and we're all set. Tonight we've got a lot to cover. G'day, Jason. Tonight we've got a lot to cover. We're going to talk about basically this stock market formula. So this is a formula that I came across, give or take, about 5 years ago now, and you're going to be surprised about it, because you're going to think, wow, that makes sense. At least that's what I thought when I first came across it. We're also going to do a little bit of reflection on last week's live session where we talked about how I'd invest $50,000, and there are a few follow-up questions that happened to come across in the I guess the comments section of YouTube that weren't live, so I can tackle a few of those. And I'm also going to try and explain to you a few reasons why I tend to invest with optimism, a few more reasons beyond the ordinary. So we'll get to all of them tonight. G'day, Mike. Pseudophile. G'day. Ethan, wonderful. JJ, say, looking forward to tonight's session. Well, I hope you are. And Raptor, you too. Welcome. Okay, I've got a book here that's just out of sight. I'll bring that up in just a moment. Why don't I go ahead and share my screen? As always, if you have any questions, please send them through. And don't forget that one of the most important metrics for us here at Selfwealth is that if you can subscribe, it kind of tells us that you want more content coming through YouTube or wherever you're watching this. If you're watching this on Raymond, I can see you're watching this on Facebook yet again. Raymond, you're one of the few people that comment through Facebook, and it's so good to have you with us every week. So if you can see us, if you can see me, hi, and I think you're following the page already, but that's wonderful. Good evening, Caroline. Our pleasure to have you here tonight. But yeah, the subscribe button is that big red one that you see on the screen. It makes us very, very sad. Here is real life footage of me tonight in bed, knowing that maybe you haven't subscribed to the Selfwealth channel. So yeah, this is a little bit of fun. I'm going to be a bit of serious tonight, mixed with a bit of kind of like, I guess, cutting through the noise and giving you some realistic way to think about investing for the long term. You should know that I bought some ETFs yesterday. In fact, I bought 4 ETFs and 1 managed fund yesterday. I didn't invest $50,000, as I said last week, but I did invest a meaningful amount of money. Not trying to time the market at all. In fact, it was just because I wanted to, and I've set up a dollar cost averaging plan. It's actually interesting. I've set up a dollar cost averaging plan with our company. So our company, the Rask Group, wants a dollar cost average as well. So we're going to slowly invest in an array of ETFs and probably shares in time as well. So yeah, this is like we're eating our own cooking. And unfortunately, due to the trading rules at Rask, I can't mention the ETFs publicly for 2 full trading days. But I'm sure you can guess some of the names if you watched last week. So yeah, before we get to kind of investing and, you know, the usual practices for me and Rob, just to remind you that anything that we do mention tonight is strictly limited to general financial advice or general financial information, which is what I like to say only. We don't know your personal circumstances. So we don't know if you have a bucket load of debt, if you have 3 investment properties and you still want to invest in shares or something like that. We simply don't know that information, and that's what you need to see a financial planner for. So any of the comments that I respond to tonight, just remember, always general financial information only. Jason, you've said Xero or Xerox? Yeah, that's from Mike's comment. Xerox did good yesterday. Actually, Xero did do really well yesterday, Mike. It did indeed. You were right. I think it went up, correct me if I'm wrong, about 4%. So I was really happy with that because obviously, full disclosure, I own 0 shares and I have held for a very long time, and I would like to buy more. So if it keeps falling, maybe that's what I want. Maybe I want 0 to keep falling so I can buy more. Anyway, let's get into it. Let's have a bit of fun with tonight's session. So just a quick note on Selfwealth. By now, everyone listening to this call would know that there was a big high-profile hack a few weeks ago that was through Optus, and then a bunch of blue-chip companies have come out and said that they've had not the same, but database vulnerabilities over time. One of my favorite writers of all time, Morgan Housel, says that privacy is an illusion in the 21st century. But I tell you what isn't: security. So one of the things that's really important when you have your Selfwealth account, and I'll blow this up a bit so you can see what I'm talking about, inside the Selfwealth account, you can head to your little avatar in the top corner and click settings, and you can enable two-factor authentication. So that's this thing down the bottom here. I highly, highly, highly encourage you to do this, even if you're not an Optus customer like I am. I highly encourage you to do this. Rob highly encourages you to do this. It's really important to have this. Even with all of the stuff that we've got at work now through Rask, we make sure that we have two-factor authentication. In fact, Google imposes it now. I think as of today, Google is imposing two-factor authentication on a lot of stuff, simply because we are creatures of habit. A lot of us just end up using the same password and the same combination to get into basically everything. So yeah, Epicurus, that's right. Yeah, Raymond, it probably should be by default, but people just prefer to have low security options. You can give people all the options in the world. They always don't, get it right. So it's super easy to set up. So just go in there, go into your account and click the button. You can even do that while you're watching. So let's get into the meat of tonight's show. So I just want to call out a book, and I'll bring up my screen really quickly. This book here, I think you can, where are you? Here? This book, Factfulness, it's on the screen in front of you. Factfulness has got to be probably the most profound book that I've ever read. And I won't spoil the book for you. I have mentioned it a couple times, but the book is not an investing book, but it is one of the books that I probably have had the most profound reaction to in my life, and even in an investing context. The book was written by Anna, Hans, and Ola Rosling here. You can see them on the screen in front of you. Hans is the gentleman in the middle. He actually, not to give too much away, but he actually passed away while writing the book. And so the last, I think, I could be mistaken, 2 chapters are written by his daughter. And so it's a book about, I guess, how to live the world through a factful lens. And this applies to investing, as you're about to find out. If you buy the book, you read it, and you don't like it, I'll buy you a beer. That's my promise. So hopefully thousands of people don't take me up on that. But hey, if you do, then more beers for everyone. So these quotes that I'm about to bring you, I think I've got 3 or 4 here at the start, are going to kind of usher in what the next part of the conversation, which is about the 7 reasons why I think the stock market could go higher, but also the stock market formula will help you understand why the stock market formula makes sense. So here's the quote from Hans. It says, "There's no room for facts when our minds are occupied by fear." Please remember this quote as we go through tonight's session. There's no room for facts when our minds are occupied by fear. Hans Rosling again. "Forming your worldview by relying on the media would be like forming your view about me by looking only at a picture of my foot, because it often only tells the ugly side of things. The world cannot be understood without numbers, but the world cannot be understood with numbers alone." This quote is especially telling for a lot of investors, because we tend to look at things and be like, well, inflation's up, therefore that's not good. Or, and this will become more apparent in just a moment, interest rates are up, therefore interest rates keep going up, stocks will fall. But there are so many other reasons that we're about to get to that influence the stock market. And in fact, all investing overall. So the stock market formula, this super secret stock market formula, is just this one. If you've heard of this, please drop it into the chat. I can see, Martin, you said you hate the book already because you just want a free beer. And I do like that line of thinking. So here we can see that the stock market formula, right, is surprisingly simple. It's the dividend yield, or the dividends that you receive, plus the profit growth and the change in valuation. So let me put this another way. This would be like saying the dividends that you get on your investment, the earnings, so that's another word for profit. Earnings is just another word for profit. The profit of a company going up, and the price earnings ratio changing over time. So when we say change in valuation, this thing here at the end, this could be the price earnings ratio. It could be the price to sales ratio. It could be the price to whatever, the price to book ratio. However you try and calculate the valuation of something, that going up or down. And I'll explain, I'll use an example in just a minute. It'll make so much more sense. Or if you prefer emojis, it's like a bag of cash plus a chart going up and a scales. So that's the one. Brenton, you said, if I buy the book and enjoy it, I'll buy me a beer anyway. Well, I feel like this is like, I didn't virtue signal anything here, Brenton, but I feel like if you want to buy me a beer, we can sure do that. And by the way, keep an eye on your inbox, because that could become a possibility in the not too distant future. So in other words, the secret stock market formula goes as such. It's the cash you get for holding your investment, plus the company's performance, plus what others will pay for it. Yes, Stu, you've said a keg. I assume you can. Yeah, I'll buy you a keg if you look. I feel like, Stu, you would have read the book. So I feel like you would have read the book already. So I don't know if that keg's already on its way. But so let's just think about this for a moment. We know from previous sessions that we've done talking about the stock market and the returns. The returns of the best performing companies over the long run typically occur because the company's performance is very good. So there are statistical studies that show that a company that reports strong profit growth and strong revenue growth will do better. The other thing is, in the short term, studies also show that within the next 3 years, for example, so from years now through to the third year, the most likely predictor of the stock market's return is not actually the company or the profit performance. It's actually what others are willing to pay you for something. So if you've ever heard the quote, the stock market is, in the short term, the stock market is a voting machine, and in the long term, it is a weighing machine. What that quote means is, in the short term, it's basically what the sentiment that drives the stock market. But in the long term, it's the performance that drives the market. So this is something that is really critical to understand. And this is the distinction that people tend to get wrong. They tend to look at this formula and say, my stocks are down, therefore I'm not a good investor. Or my stocks are down, therefore something is wrong with the company. But that's often not the case. Often that's just this thing at the end here. So let me give you an example. This is another company I own, and I know you guys know that I own this company. It's Pro Medicus. It's the ticker symbol ASX PME. So PME. So it's this one right here, the Pro Medicus. Now, Pro Medicus in the last 10 years is up 10,600%. 10,600%. It is the number one performing stock on the stock market over the past 10 years. It's probably one of the best performing stocks in the world, to be honest. And it's a company that you guys know does medical software, right? But you can see the share price going from basically nothing all the way up to $60 recently, right? But if we look at it, we can actually look at the company's price earnings ratio over time. So what this chart does is this chart compares the share price to the profits of the company. Now, what you can see is that since 2015, around about here, or even 2017, over time, the valuation of the company has gone up. So that would be like saying in this thing, the valuation has gone up because the price that investors are willing to pay for every dollar of profit has gone up. At the same time, the company's profits or earnings have gone up. So not only has the company begun to perform well, investors are also willing to pay more for it. And that's why you have a share price that's up 10,600%. It's not purely because, investors are getting ahead of themselves. It's not purely because of that. It's also because the company's profits have done really well. So you can see here, it's up multiples of what it was, even just 5 years ago. So here we have a company that has impressed shareholders. So shareholders are willing to pay more for it, but also the earnings have gone up. Little late to the chat, Umbrella Lemming, but hey, you're here. Better late than never, as you say. So we can take this formula of dividend yield plus profits plus change in valuation. And by the way, the chart for PME, for Pro Medicus, isn't including dividends. It's also paid fully franked dividends. But we can take this formula and we can also apply it to the stock market overall. So the stock market overall in the United States is this one right here. This is the S&P 500, the top 500 companies in the United States. And here we can see that the stock market since 1980, I think it's 1984, it could be a little bit earlier than that, is up 2,600%. Again, not including dividends. So it's up 2,600%. So why is it up so far? Now, the most obvious reason, and here's a chart since 1870. This chart goes way back to 1870, a very, very long time. And this chart shows the profit of the companies in the S&P 500. They're not the same companies, but it's like the top 500 regardless. So in the year 1900, it would have been a bunch of railroads, for example. And in the year 2000, it would have been a bunch of technology companies like it is today. But you can see here that the profits of companies tend to go up over time. And in fact, when I did the numbers on this, they went up on average between 6 and 7% per year over about 150 years. They don't go up every year, of course, which I'm about to get to, but the earnings do tend to go up. Companies tend to get more profitable over time. Recently, what we saw, however, in the United States, during COVID and whatever, and when the stock market really rallied high, we can see that here at the peak. The reason the stock market rallied so high was actually not because of the profits of the companies. It was actually because the valuation stretched. And so we can see it here, the very right-hand side, we can see the valuation of the top 500 companies went way up. So this is like the average price earnings ratio of the top 500 companies. And we can see that's about 35 to 40 times, which is well above the average. And only now is it starting to come back to what is probably more reasonable, more average, you could say. Ethan, you said, what was the chart that includes dividends? Ethan, the chart that includes dividends is the S&P 500. So the S&P 200 total return. And it's this one right here. And then you can select if you want total return or not. I've actually got it on the Rask website. I don't want to be too self-promotional, but you can see it here. You can see all the different options. So over, say, 5 years, or 10 years, we'll say, just the share price version is up 4%. But if we've got total return, I think this might default back. It sometimes takes a moment to load. We'll see. So it's 4% just for the share prices going up. And we can see over 10 years, it's 8%, so nearly double, right? So that's the key input there, is it's nearly double for dividends. And that's why we say don't rule out dividends in the equation, right? So when we look at, say, this thing here, don't rule out the dividends because that could make up. Typically, what we say, or what I say, is that the dividends will make up 4 out of every $10 that you might get back from the stock market overall. 4 out of every $10. In the US, it's probably lower. You probably get more growth, but that's just the rough rule of thumb that I apply. And to see what it actually looks like, I think I can actually show you what it looks like on the Rask website. So just real quick, that doesn't actually show it. No, I used to have a chart on here that showed the difference between the total return and the price return over time. And the dividends one tends to be a little bit more stable. So anyway, we can see this applied to the stock market overall. So the formula works. So the basic theory and the basic idea, the thing that I want you to take away from this is that these first 2 things in this formula, and there's no doubting it, it's just a formula and it works. The first 2 things in this formula have to do with your ability to pick the right things to invest in, right? So this is like saying I pick Pro Medicus because it's going to grow and it pays a dividend. You got the company right. And we don't always get the company right. Like oftentimes, in fact, more often than not, investors get it wrong, right? But the final thing, the change in valuation, is something that none of us can control. Really, the only way that we can control it is what we call timing. So we either say we're going to get in at the low point and sell at the high point or something like that. But then you've probably heard us say it's about dollar cost averaging. If you were to just invest the same amount of money over 100 years, the same amount every year, so say you put in $10,000 every year over 100 years, your returns would be extremely close to the average, because you would end up removing this. The valuation and the fluctuation in the valuations would just neutralize over time, because you'd have 100 different years of which to test your investment process. So this is why dollar cost averaging works. People often ask me, well, what's the long-term expectations that you would have from the stock market? Well, I'd probably say something like, it's probably going to be something like 6 to 7%, maybe plus a few percent in dividends. That's pretty much, if I was going to default, that's probably what I'd default to. And so that's like, if someone asks you, well, how can I get a return from the stock market? You just say, well, just invest in a diversified way and just expect high single digits over the ultra long term. Now, the one thing that you would say is that in the short term, anything could happen because the valuations could change. And that's probably the key thing, is a lot of people take that short-term price movement and think that that's the stock market. No, that's actually just the change in sentiment. So now I want to transition from this conversation, which is pretty theoretical, into a bit of fun. A bit of fun from some grim situations. And I want to throw out some reasons why the stock market overall might do better than what people expect. Now, really quickly, if you do have any questions, please send them through. I know you're all a bit quiet tonight. Kish, you said I'm a regular listener, first time logged into the chat. Kish, welcome. Welcome. That's wonderful. Stuart, you did say, yes, Hans Rosling is a legend in the analytics/storytelling with data space. He absolutely is indeed. Stevie says the secret stock market formula is to do the opposite of my buys and sells. Yeah, I mean, I don't know if I've told this story before, but they used to do this thing I don't know if they still do it, in the Sydney Morning Herald, where they got 10 experts and it was like 3 or 4 experts and a couple of readers of the newspaper to pick a stock. I think it was 1 stock or 10 stocks a year or something like this. And then they would track the performance of those stock picks every week. And they did this for a little while, maybe a few years. And one year, just to be different, is they inserted the Reaper, who would do the opposite of what someone else did. And what happened was the Reaper ended up almost winning. So kind of did the opposite of what everyone else was suggesting. The Reaper almost did well. And I guess that just, for me, highlighted the kind of like the inaccuracies and the kind of difficulty in trying to predict what happens in the short term. But yeah, I think that's the thing there. Fleur, daylight savings, yeah. Raymond, you've said 7% average. Isn't it better to buy Lego and sit on it for 5 years? What's the return of Lego, Raymond? I would love to know what it is, Raymond, over on Facebook. I feel like Lego is one of those things that has just transcended generations and done really well. I don't follow it that closely, but I feel like, Raymond, what you're getting at, Lego is quite the long-term investment. There's a lot of it getting around, I can tell you that much. So while you think of your questions and you pepper me with some ideas, I'll move on to the next part, which should be pretty quick, actually. So here are 7 reasons why the stock market could do better than what people are expecting. So reason number 1 is that the war in Ukraine is resolved. A lot of people are talking about, very scary things, but if this is resolved quicker than expected, we will see inflation fall. We'll probably see energy prices retreat a little bit. And we'll probably see just a lot more positive sentiment in the world. So that's one reason. The second reason is that the China-Taiwan tension and US tension cools down a bit. This is another massive geopolitical risk for people at the moment. They're thinking, well, what's happening in Taiwan? What's happening in China? I was chatting to a global macroeconomic expert last week, and it actually came out on the podcast today, the Australian Investors Podcast. This guy named Craig Ferguson was telling us that, if anything, the last 10 years has shown us that investing in economies like China, Russia, these types of places is actually very risky. Not just from the companies themselves, but also just the government, and what can happen. It's just very, very risky. So, Brendan, you said Lego Millennium Falcon costs the same as the real Millennium Falcon. Wow. Okay. G'day, Jaden. Welcome to the show. Okay, so reason number 3, and this is the one that I wanted to circle back to a bit. Is it possible to use presentation mode? I could try and use presentation mode if I bring this up. How do I do this? This would be a good question. I think what happens if I press this, I could be mistaken. I think it absorbs my whole screen, and I don't think you can actually see me, and I can't see you. I'll try and zoom in a bit, and I'll go a bit more like this. So reason number 3 is that the stock market could do better from an earnings growth perspective. Whoop, I've lost you again. Could do better from an earnings growth perspective. And so one of the things that I'm about to show you in just a moment, if I can get this zoom right, it's not showing me the right things. Let's see if I can bring it in. Oh no, I think I've lost it. So guys, 1 second. This is what happens when I try and do too much at once. Let's go 100%. There we go. So one of the things that happens in the stock market is that the profit growth is what's most important for people. So if we go back to our focus before, and we remember that profit growth here is one of the key predictors of the stock market's performance. What analysts try to do and what data companies try and do is they try and say, well, let's get all of these smart analysts in a room and let's try and predict the stock market overall for the next 12 months. And probably the most reliable data provider is FactSet. And you can see this news release just out a week or so ago. Here, you can see that based on the average improvement in earnings over the past few earnings seasons due to companies reporting positive surprises, it is likely that the S&P 500 companies will report growth of between 6 and 7%. This was just, I don't know if they're just taking the long-term average here or what they're doing, but that's smack bang on the exact average from the past 150 years. So you might be mistaken if you read headlines like what's going on in China, and I'll get to some other things in just a minute, you might be mistaken for thinking that companies in the United States are doing really poorly. But at the moment, they're holding up. And for the next year, in fact, it's probably the same forecast. They seem to be holding up. The US stock market seems to be holding up. Now, one of the reasons that one of the things that I wanted to bring to your attention tonight, in case you haven't been over this before, you haven't seen this, is that the stock market and all stock markets overall are what we call forward-looking. Now, you might have heard this before, but what it means is that the stock market reacts to what's expected, not what is already known. So, for example, if the Reserve Bank of Australia comes out and says, we're going to increase interest rates by 5%, we're going to do that in 2 months. Everyone would freak out today. They don't wait for 2 months to do that. They freak out now because it's what's expected. They expect bad news to come and so on and so forth. It's also why economists have a job, I'm pretty sure. But it's also why librarians aren't the greatest investors. Because if stock market investing was about how much information you knew right now, the people who read the most would be the best investors. But that's not the case. It's also why the media makes a big deal when an expert gets on TV and says something. And it's why fund managers always like to make bold forecasts because they get the most media attention. So it kind of has this like cyclical effect where it's like a cycle of people making bold forecasts and then people getting in the media and then people making more bold forecasts. This is why some of the fund managers in Australia, particularly the ones that are on the TV or one of them's on prominent on Twitter, I just totally disregard everything that they say because they make a new prediction every day and it's normally the most gloomiest and scariest thing that they can think of. So another reason that the stock market could rebound is that core inflation doesn't go up as quickly as expected. And this is the number one issue in the global economy right now, inflation. But not just inflation like you see on the news. It's the inflation that comes from things like wages. So when wages go up, like let's say, for example, that your wage goes up $5,000 in the next 12 months, it is extremely unlikely that your wage will fall by $5,000 next year because it typically stays around. And so what happens is if wage goes up, typically then you start to spend more, which means that there's more inflation, and it keeps going and it's sticky, so it stays around. So I can see Peter said central banks don't want to beat inflation; they need to inflate away the value of the big debt, and that's a fair comment there, I'd say, Peter. So I guess one of the things that I've come across in speaking with a lot of experts over the past, say, 10 days, Peter, I've been around Australia the past 10 days speaking with investment consultants and institutional investors. And what I've found is that most of them tend to suggest that they think inflation will stick around. So just in this chart here, I know it's very small, I can't even read it, but basically what this shows is this blue line is basically the core inflation. So this is the stuff that kind of stays around. And you can see, and it takes longer to go away, obviously. So you can see here that in this data set, they expect inflation to kind of be sticky and to stay around. And that tends to mean that interest rates will probably stay high. Now, Peter, you've actually touched on something which I've kind of alluded to in recent presentations, which is that because the elephant in the room, is that the central banks around the world have been selling all this debt again and again and again and again. And there's so much debt from the governments at the moment that people don't know the way out of it. The most logical way out of it, according to everyone that I know, is that the most logical way is what Peter just said, is that we keep interest rates a little bit higher than they have been historically. And what that does is if interest rates are a little bit higher, it pushes down the value of the debt that's already been issued. So that means that, for example, that the debt that was issued at 0% interest rates actually becomes less valuable. So then that goes down and it's easier to repay in time. So that's key there. Jason, you've asked, what's the time scale here? So this goes from 2017 through to mid-2022. So that's that. Sparky, you said, I heard from CNBC that if the Fed stopped raising interest rates and bond yields settle, the market will rally. Any thoughts? Yeah, so that's the latest news out today, Sparky, basically, is that if the Federal Reserve stops raising interest rates, I think they're at 3.25%, the stock market will rally. And that's exactly why I put this here, because if that happens, the stock market would rally. Because it would make sense. Because once again, if we go back to the previous slide where we talked about how inflation expectations are what matters, currently people are expecting over 4% will be the new normal for interest rates. Raymond, you said, what is the impact of interest rates and also high property values? Any tie-in? I've heard that's the saying that the US market sneezes and the ASX catches the flu. Yeah, that's a good point. Let's get to that. That's actually my next couple of things right here. So the first one is just that the interest rate increases in Australia slow down. You don't have to, like someone said to me recently, you don't have to be a rocket scientist to work this out. The interest rate increases that we've seen recently in Australia and in the United States are yet to take effect. So a lot of people have gone, oh no, my interest rate is going to be higher. I won't be able to save as much, but we're still spending. All of the data shows that as an economy, we're still spending on retail goods. We're still spending on travel. We're still doing all the stuff that we're not supposed to do if interest rates go up. So I think what will happen is it will take time, but it will bite us. You know, just personal example is my mortgage on this house has gone up $800 a month. I'm fortunate I can afford that, but there are a lot of people that can't afford $800 a month. So it doesn't take long for that $800 to start eating into other budgets that might go elsewhere if you're going to go spend at JB Hi-Fi or something like that. So Raymond, one of your questions was this. Basically, like if the US dollar, if the US dollar kind of shows less strength, that sounds strange, but if the US dollar stops being so strong, that might actually stabilize our stock markets a bit. And the reason why is so in Australia, the Australian dollar, and I think there are ETFs that track this, but if we just bring up bring this up here, AUD USD. So if we just look at the Australian dollar over the past year, don't mind that glitch there, it's fallen, right? But flipped on its head, that means that the US dollar's got stronger against our currency. And that's because during a crisis, like we're seeing now, an economic crisis, if you like, at least the fear of one, the US economy gets stronger. And I think over the past 5 years, we've seen that the US dollar strength is what's really guided that country, and it has enabled the US economy to thrive. But anyway, if the problem is, if you imagine that, for example, so I think I said this 2 weeks ago, but of the top 500 companies in the United States, so these are companies like Apple, Google, ExxonMobil. You look at these companies and you think, oh wow, the US dollar, I should invest in those companies. Unfortunately, for a lot of these businesses, they make a lot of their revenue outside of the United States. So what happens is, if they're sitting in the United States headquarters, that means their operations in Australia are going to be less profitable. That means their operations in the Middle East or Europe are going to be less profitable. So what we've seen recently is that the US dollar basket, which is this is like think of this like a currency that compares the US dollar to 6 other currencies. You can see how it's spiked. This is since the 80s. So we can see here, like this is actually going in the wrong direction for a lot of US companies. And my final chart here is just sentiment. And this might be a bit confusing, but I just want to show you here just one final chart, and then I'll answer some questions. But this chart actually shows the Australian stock market, and I'll see if I can zoom in a bit. Apologies again for anyone that's on mobile or something like that. Maybe you turn your phone sideways. But here we can see the dividend yield, and this comes from Market Index, and it shows the average dividend yield on the ASX since 1980 is around about 4.1%. But we can see during COVID, the average dividend yield fell. And that's actually not because dividend yields fell, it's because valuations went up. So when valuations go up, the dividend yield goes down, right? But now what we're seeing is the opposite. If you think about it, the average dividend yield in the United States is around about 2%, right? But the interest rate that you could get from a bank in the United States is around 4%. So why, if you were a retiree or you're someone that's more risk averse, there's no way you'd invest in the stock market. You just invest in like a term deposit because it makes more sense. So I think for most investors, this is kind of like a new normal that we need to get used to, is that, the stock market is not just going to go up just because interest rates fall. In fact, we might see a bit of ebb and flow over the next 10 years. But if, for example, if we see interest rates cool down, then we might see people come back to the stock market for the dividend yield, and that would improve the valuations overall. So I can see there are a lot of questions that have come through here, so I'll just quickly respond to some of them. Stevie, you said, not sure who told me, could be me. They said, Australia is in a unique position. When the US dollar goes up, Australia benefits from its exports of coal and iron ore sold. That's what helped us avoid 2008. That's correct, Stevie. I may have said that to you. Because if you think about it, this is a big reason why a lot of our iron ore companies have done so well recently, because the Australian dollar has dropped. What that actually does is it has a two-pronged effect. Because BHP reports in US dollars, what it actually does is it means that the costs that BHP pays its Australian mining workforce is in Australian dollars, which is less because it reports in US dollars. But also it means the product which they sell internationally, they get more for. So their profit margins go through the roof. We saw this with Fortescue. We saw Fortescue report that its costs were only about $16 a ton. They do report costs in US dollars, but the costs are about $16 a ton, and the price that they received was about 135 at one stage. So there's a huge profit margin there. And it probably isn't so much the US dollar that saved us in 2008, Sparky. It's probably more so the China infrastructure boom. Peter, you've said China is still not drinking in the volume of oil it was when OPEC will put global oil consumption over global capacity. Yeah, I mean, this is the thing, Peter. I think one of the things that we have to be mindful of as people focused on the commodities market as well is just that overall, we are transitioning more and more to electric vehicles, and that's the number one place to actually look at that is actually the Chinese economy. So there's a huge focus on renewables and electric vehicles in the Chinese market. So this is an interesting case study to see how oil consumption returns to the Chinese economy. Pseudophile, you asked a great question here. The A200 ETF, and I'll share my screen. I'll go back to share my screen. You've seen enough of my ugly mug. So if we go back to this screen here inside Selfwealth, I said the A200 ETF gives decent dividend yield. So is it primarily for that, or would it also be for growth long term? Same. It's a great question that you've come up with there, Pseudophile. It's actually the same. You'd use it for both. Because in Australia, companies typically pay more in dividends, so you get franking credits. It's the same with an ETF. An ETF just passes the dividends and franking credits back to you, so you get the same. So you get a better return because there's dividends paid. A lot of people. I can't do it here inside Selfwealth, but I'll just do it over here. People like this, and then they compare the ASX 200 to something like, let's say the NASDAQ 100, they get something like this and they go say, over 5 years, the NASDAQ has performed so much better than the Australian market, which it has. It clearly has because it's got more technology companies. However, it's important to remember that the Australian companies pay more in dividends. And if you had reinvested those dividends, it might have been a different outcome. So for example, I'll see if I can bring this up here. This is the total return that was mentioned before. So I'll just get rid of that. You can see if we included the total return, you've got a much, much better return. That's because you've included dividends, right? So that's a key input, and a lot of people tend to forget that. You can see here, if you included dividends, I mean, that's not very accurate, but even over 5 years, the return is almost 3 times. So that's probably a worthwhile factor to consider as well. So you get dividends and you get growth over time. Ethan, you said, would Ticker be a good site to look at historical dividend yields? Yeah, that's one way you can do it, Ethan. You can use the Ticker terminal, which is the subscription data provider. Yeah, you can use that. Fleur, you've asked a fantastic question, which is, how much impact does England's different economic reaction affect the Australian stock market here in Australia? That's a great question. So many of you will know that the Bank of England, BOE, I'll see if I can put that in and see what it comes up with. Okay, it comes up with something totally different. But the Bank of England had to basically come in and rescue the government. I actually did a podcast on this, which went out last Saturday. Fleur. It's on the Australian Investors Podcast. If you look that up, Australian Investors Podcast and BOE, they'll come up. And I can't really explain it as well as the guy that explained it to me did. Basically, we saw the Australian stock market, and we can probably see that here if we look back over the past month. We can see the Australian stock market took an absolute whack around the time. And I'll try and explain it to you in the simplest possible terms. So what happened is the new government in the United Kingdom came in and basically said, hey, we're going to cut the tax rate, and also we're going to give about 90 billion pounds to businesses and to individuals to help pay for their electricity bills. And everyone was like, well, that's fantastic. The only problem is you've got 10% inflation. So if you just go and put 90 billion pounds into the system and make all the wealthy people, pay less tax, basically what you're going to have is you're going to have more people spending money. So you're going to have more inflation, and then it's going to go out of control. And so this was a very new government, and a government that thought that they were doing the right thing. And if you look at the last 20 years of politics around the world, not just in the UK, you could see that governments could pretty much just do that. They could say, hey, we're going to cut taxes, and by the way, we're going to give everyone some money. And it's worked. But it's only now that the financial system has said, no, hold on a second, that doesn't make any sense. Why would you do that? It's just going to make inflation worse. And so that's basically that's probably the key thing to keep in mind in terms from an economic perspective. We haven't really seen that in Australia, but the key, I guess, reaction from it is that the financial system says, hold on a second, this doesn't make sense. And the government's getting instant feedback from that. So that probably means, now I'm not saying this for sure, but what it probably means is the governments will be more cautious before they think that they can just hand out money and solve a problem. That's probably the thing, because what we saw in the UK is that was a pretty drastic issue, because the pound went straight down because everyone was like, well, I'm going to get out of this country. It doesn't seem very stable. Seems like something an emerging market would do. I'm going to get my money out of the UK, which is going to push down all the prices of investments in the UK. And then the pension system over there really struggled. That's my kind of 2-minute version of it. But I hope that makes sense. And just and I think Rob's just put a great comment in. Just a reminder that if I do answer any questions or anyone else in the community answers any questions, just a reminder that it's general in nature. We don't know your personal circumstances. Jaden, will you be covering US companies reporting season? I can, Jaden, if you give me 5 companies. Give me 5 companies and we'll take a look at them. Why don't you guys type them into the chat? And then from those, I'll select the 5 that I know well and we can go over them. By the way, we'll be doing our giveaway in just a moment. I'm just delaying a little minute until we get to that, but we'll be doing our giveaway. So be sure to remember which are the most popular companies and we'll do the giveaway in a few moments. Robert, you've asked a question. Oh, yeah, Robert, you asked 2 questions. You made 2 comments. I brought my first ETFs earlier this month, VAS and VEU. So VAS, VAS. I'm looking for passive investing and I understand I need to diversify. I need to buy IVV or VTS. However, the cost is so expensive in comparison. Is it better to just go to a single ETF such as VDHG? Yeah, I think that's that's a great question, and Rob's kind of attempted to answer it. Yeah, so you can look at what you're already holding. So Rob's does bring up the point that something like VDHG, this ETF, which is a diversified ETF, already includes the equivalent of VAS. And VEU, I'll go with, already kind of in there. So you don't necessarily, by adding another ETF, you might be getting a similar thing, is what Rob means to say. So that's important to understand. And you've asked another question. If so, should I sell my existing holdings and go all in on VDHG? That's more, Robert, when I think about this, the answer to this question, obviously we can't give you personal advice, but one of the things that I often get a question from our members is, well, should I just use VDHG over this other stuff? And for a lot of people, that probably makes sense. But for some people, like when we covered last week on Selfwealth Live, I think this would be Selfwealth Live 50K. If you go back and look at this, Rob, and I'll just... where is it? It's $50,000. Look at me just looking up things in Google. This one right here, if I get rid of this, if you go to this video right here, this is the one that you want. And in here, I talked about the 50 grand and how I'd invest it. But then a little while back, I also said why I would use VDHG as well for a tax return. So there's really 2 different schools of thought here. You could do one, so you could use VDHG, or you could do one yourself where you kind of, so you could use VDHG, or you could do your own portfolio where you kind of create it from scratch, which is kind of my preference for me, but it doesn't work for everyone. So RBTK, you said, I thought the wealthy people keeps reinvesting their money. Yeah, they do. So if you gave wealthy people a tax cut, RBT, they'd probably just take their money and just reinvest it. Which probably wouldn't have the effect that the UK government wanted anyway. I can see, Jason, you've guessed CCL. What's CCL in the Carnival Corp? Is this the, Jason, you're going to have to film it. Is this the travel cruise line? Yeah, it is. I've never actually looked at it, but I remember this company got really affected by the coronavirus, obviously. So interesting. Jens, you've said PN for me to cover. Again, PDN, this one? Is this the one that you're talking about? The RAFI Developed Markets XUF ETF? I'm actually chatting with Invesco next week. So interesting. Peabody, Peter, that's great company. Domino's. I think we've talked about Domino's a lot lately, Stevie, but I can talk about that again for sure. So Anthony, you've said VDHG doesn't double dip on management fees too, just to top. Yeah, that's great. That's a great point, Anthony. So when you invest in one of these ETFs that is a diversified ETF, it doesn't do that. Michael, you've said, Owen, do you need to complete a W8 Ben form to purchase IVV ETF shares? Jens, you said Paladin. So Paladin's an Australian company. If you just send me some US companies, we can do like a bit of a US roundup on earnings. I would love to do that. Like all the companies that I like to follow: Apple, Google, Tesla, Okta, Salesforce, Adobe, All of these companies, I love these companies. So if you want me to go over them in one session, we can. Anyway, back to that, Michael, your question. So just so you know, the way it works, so this is a great question, Michael. I'm just going to explain the kind of education behind this before I give you a crystal clear answer. So a lot of people, when they try and decide on which ETF to go with, they either compare for the global markets, they either go with IVV, which is this one right here, the S&P 500, or they go with the VTS ETF from Vanguard, which is the US stock market ETF, or they go with VGS. VGS is the global shares. Now, VTS is a US listed ETF, it's an Australian listed ETF, but it's actually for US tax purposes. It's a US fund. So whereas this fund is actually an Australian fund. Now, if you look into this, if you actually look inside of this ETF, what you'll find, pardon me, if you go inside the Australian version, I think we're on the US version right now. Let me just go back and have a, here we go. I think this is the Australian one. If you go, yeah, this is the Australian one. And the only way you know, guys, is if you're looking in the URL. But if you go down and you actually look at what this ETF, the IVV ETF, you actually look at what it's invested in, right? You see here, it's just invested in the US version of itself. It's invested in the US version of itself. So IVV, you see it's this one at the top is just invested in this one at the bottom. So you'd be like, well, why did they do that? Whereas Vanguard, you actually invest straight in the US one. The reason is BlackRock or iShares made it this way so that you don't have to fill out the W8 Ben form for IVV, but you do have to do it for Vanguard's VTS. So what happens is everyone has to fill out a W8 Ben form, everyone that invests in the United States. The only difference is with these two ETFs is that iShares have created an Australian version called IVV and invest that money in the US version, which also happens to be called IVV. Now, the tax form is actually done by iShares in this one. So it's actually done at it's actually done at the fund level, right? Whereas this one is not done. So that's why you have to do it, because this is actually a US ETF. It's actually a US fund. So whenever you see an Australian ETF that invests in the United States and you don't need to do the tax form, that's just because it's already been done by the fund itself rather than the individual investor. I hope that makes sense. So it's a no, it's a yes for VTS, it's a no for IVV. So I hope that makes sense. Jason, isn't that a fee double up? Yes, it can be, Jason. It can be a fee double up, but if you just look at the ASX numbers, that's how you get a sense of the true look through of the value, the fees. Sorry. So no W8 Ben form is what I should have said. Yes, Eve, you're correct. So we've got some questions. And Netflix says, Jens, Netflix, yes, good company for us to focus on. Tesla and Amazon earnings. Okay, so I'll add all of those to a list and I'll come up with 5 and we'll just cover the top 5 that are most popular. Okay, so and just a quick comment here from which I think makes sense. Sam J, you've said you like to create your own portfolio of ETFs because you it gives you more control, and I agree. Okay, so now we've got to do the fun thing, which is the giveaway. We've got a couple of minutes left, but tonight's giveaway is going to be a little bit different. Tonight's giveaway, because you could have guessed, and I've got it all here on my phone, just so I don't make the mistake of showing you all the answers before I do it. Tonight's giveaway, I need you to guess the second most bought and the second most sold stock on inside Selfwealth. So normally we do this, and normally we either exclude or we include ETFs. Last week we had 8 or 9 winners of the prize, which is fantastic. But I think this week it would be too obvious. So we have to go with the second. So the second most purchased share inside the Selfwealth community and the second most sold share inside the Selfwealth community. No ETFs. ETFs are excluded. If you guess that, you get a pass to my Value Investor program, and you also get some fame here on Side Selfwealth Live, and you also get some Selfwealth trades, so you can trade for free. So it's a bit of fun. Please put your guesses in the chat. I can see Reese has already guessed Westpac. If you can tell me which one's your buy and which one's just sale, that'd be great because then we know for sure that you got it correct. So put buy, ticker symbol, sell, ticker symbol, then we know. And Jason, you've said, and while everyone's getting their guesses in, I will read some of the comments. So Robert, you've said, I only learned about the W8 Ben form document recently. Unfortunately, I will need to sign one for VU after purchasing. Yeah, to be honest, it's a bit of admin. It's not the end of the world. It's just not the end of the world. Like this is interesting because the Rask YouTube channel makes revenue from the United States. I need to fill one out for our company just to get YouTube ad revenue. So, these things, you kind of get it in every walk of life. So, Jason, you've said, an electric car roundup might be interesting, Owen. And Neo, Tesla, and Polestar, among others. Yeah, I think, what's interesting, Jason, is Renault is also a company that's very involved. I don't know if it's listed on the United States Exchange. It doesn't look like it is. But Renault is actually a company that's very focused on electric vehicles, and so is BMW, obviously. I don't know what the ticker symbol is for BMW, but yeah, all of these businesses could do it. I think Tesla's, to be honest with you, though, Tesla's the only one that's done it at scale. No other electric car provider has achieved the type of revenue inflection that Tesla has. So just if that gives you any sense of it. Okay, I can see everyone's getting their guesses in. I'm going to start in reverse order, and then I'm going to put a comment in the chat so that we get no late guesses, because otherwise I don't know exactly when everyone gets their guesses in, and you could just guess after I've told all the answers. So here we go. We're going to start with the bought, most bought first, and we'll go in reverse order. In at number 5, we've got BHP. So I'll put my comment in there now, and I'll say, here we go, top 5. Okay. In at number 5 on the most bought list was BHP Billiton, the big iron ore miner, the big Australian. In at number 4 on the most bought list is ANZ Bank. People moving into ANZ Bank lately. I think dividends are back in vogue, so everyone's piling into bank shares. In at number 3 on the most bought list is actually a company that I didn't think would be in the list, is Qantas. Everyone buying Qantas shares lately. One reason or another. I mean, I'm sure you guys can fill me in. Like Warren Buffett, I have a 1-300 number that I call just to get my head read every time I think about buying an airline stock. In at number 2 is Westpac. So if you guessed Westpac, I think a few of you did, as the number 2 most bought this week, you are on the money. Westpac has climbed up the list, and this is not often in the list. So I think it's a really interesting trend that we're seeing with bank shares slowly creeping up the list. In at number 1, and there's no surprise here, hence why I kind of didn't put this in the list, is Pilbara Minerals, as we all know. So Pilbara in at number 1 on the most bought list. So in reverse order, we've got BHP at 5, ANZ at 4, Qantas at 3, Westpac at 2, and Pilbara at 1. So if anyone guessed Westpac at number 2 for the most bought list, you are on the money. You are still in the running. Let's go to the sales. In at number 5, BHP was both the 5th most bought stock, but also the 5th most sold. The next up, Fortescue Metals Group, in at number 4. We've done a deep dive on Fortescue quite a few times. Really interesting business. The future industries is really interesting. This is one company that's the next company is a company that's only ever appeared in our list once before. So I have to check this. It's Tesla. Tesla is the 3rd most sold. And you can see this chart. Everyone thinking, oh no, Elon Musk is about to buy Twitter. What is he thinking? What is that going to do to my Tesla shares? Is he still going to run the company? What's going on? In at number 2, on the most sold list, we have Core Lithium. So if you guessed Core Lithium and Westpac, you are a winner of tonight's prizes. So what are you going to do if you won? Email marketing@selfwealth.com.au. Please send a screenshot or some sort of proof of your username on YouTube so we can verify you correctly guessed the answers. The Core Lithium in at number 2, up 8% today. And in at number 1, on the most sold list, no surprises, is Pilgrim Minerals. We can see consensus amongst investors still slightly on the buy side for Pilbara, hitting a huge inflection point in revenue and profits and so on and so forth. So the business itself is firing on all cylinders. We can see Stevie said Kanye bought his own social media platform, needed to beat Elon at his own game. Yeah, that's I saw that on Twitter today, Stevie. That's quite funny. Yeah. So US companies are definitely creeping up the list here inside Selfwealth. Don't forget, like a lot of people still haven't activated. Just from like what I can tell in speaking to people, a lot of people still haven't activated the US trading inside Selfwealth, and it's so easy to do. You can trade both ASX and ASX shares in one. Anthony said, Owen, can you show the taking profit / reason for Tesla? Yeah, sure thing, no worries. So I'll bring that up right now. That's the chart that you're referring to, this one. I think is it down here? Yeah. So you can see why people are selling. So most people are taking profits. This is probably the least number of taking profits, but in terms of buying, we've got companies' earnings potential looks good, aligning with target portfolio, so on and so forth. It is the most held US stock, which is pretty cool. That's fantastic when you think about it. Does anyone want to know why? Like, why? I don't know the actual answer to this question right here. Why would Tesla not have a high ESG score? Is that because I really don't know the answer? Someone else smarter than me would probably know the answer to this. Is that because of, looks like their workforce scores are pretty low? I would have thought it'd be higher than that, particularly for environmental. It's kind of leading the world on renewables. So I don't know exactly. I can see a couple of questions here. So one of the questions is, which stock / sector will benefit once the USD moves back to normal? Heaps of Australian companies will do that. So, so that's like heaps of Aussie companies that would benefit from that. Which companies would I assume? Any company that relies on US dollars as imports would probably be a company that will require that. So companies that import a lot of products probably would be the answer to your question. Sparky said, Owen or Rob, I have seen Selfwealth does investing for kids. Have you done a webinar on it? And is there a portfolio structure like VAS, NDQ, IVV? Rob, I think there's a good blog on this on the website. You can actually activate this pretty simply inside your Selfwealth account, Sparky. So I think, the same rules apply. You can go and get a pre-made kind of, like you can just kind of think of one of the portfolios, or you can just use ETFs or shares or however you want to do it. I don't think there's any prescription necessarily. Yeah, so Rob's just dropped it in the chat, how to turn it on for kids. Yeah, right. Ethan, you've said for Tesla, what they published recently was pretty average. But we can talk about investing for kids. To be honest, Jenny, you're back. Welcome back. Yeah, so a lot of the ETFs that I would buy for my kids are very similar to the ETFs that I would buy because I'm a long-term investor and I expect they are too. Jens, you've said buying shares or warrants 2029. Buying warrants, I don't know what you're referring to there, Jens, but what I can say to you really quickly is that I once upon a time experimented with warrants. And just so for people that don't know, a warrant is it's a financial contract that you can purchase just like a share. And it actually adds leverage to your position. So instead of buying one share, you might pay for only one share, but you get exposure to 50 or 100 or something like that. Everyone's kind of a little bit different. And I basically blew myself up with those. So that was my experience. I don't really have an opinion either way, other than maybe I didn't use them right. But I'm just happy to let the grass grow in the backyard. Someone once said to me, investing in the share market is like watching grass grow. And I was thinking, well, that's fine. I'm happy to let that happen. I don't really need to take the risk. We've got some interviews coming out, the podcast soon, which talk about all of these wonderful things. But hey, I've got a few more slides in my presentation. We kind of know that there's a few jokes on this page. So EFT is not how it's spelt. It's ETF. Remember that. We didn't have Lake Resources in the top list this week. I know a few of you will be devastated with that. But anyway, I wanted to end with a quote. And this is probably the most fitting quote from this book. Factfulness. It goes like this. Remember, things can be bad and getting better. And this is the key thing. Things can be bad and getting better at the same time. Remember, we invest looking through the windshield, not through the rearview mirror. We expect things to happen. And over time, there's a fantastic website which you can go on, and it's actually created by the Rosling family, I believe. You can go on this website and you can take a survey about all of the world's biggest problems right now, and you will find some fascinating results. I went through all of these, and on average, I think I got 78% wrong. It's just a free website. You can go on and you can take these tests. I got 78% of the questions wrong. I'm very sad to say. But if you haven't subscribed yet to the Selfwealth Live, we go live quite often, every week, in fact. And the easiest way to stay up to date with what we're doing is to subscribe to the channel. We did have a few comments come through from last week's video. And one of the key comments from this video, where is it? I've just lost it. One of the key comments from the video here was, I think it was from Jake. And Jake said, you said don't invest all the money at once, do it over a period of time. But with these ETFs, they follow an index, so does it really matter? And as you said yourself, it's about time in the market, not time in the market. So surely, given that the first step is the hardest to take, when it comes to ETFs, buying sooner is better than later. This is a fantastic question. So in the last week's video, which I would encourage you to go back and watch that, I did say that, even though the headline says $50,000, if $50,000 is everything you have, we don't necessarily advocate for putting it all in the market at once. But I was talking to an investor last week when I was in Sydney, and he said, well, you probably could. But I kind of disagreed, because I just think from a behavioral perspective, I'll tell you a story that I heard. It's probably best illustrated through a story. I recently heard about a family that sold their house, and they're an older couple. They sold their house and they put all their money into super to take advantage of some things. And what they didn't realize is that when they put all of their money straight into super, it would be invested in the stock market, just like almost everyone's superannuation is. And anyway, they put their money into superannuation with the intention that they would pull it out again a few months later to go and invest in a new property that they would live in. Within 1 month, the value of their superannuation fell $50,000, but they had to sell. They had to pull the money out so they could buy this new house. And so within basically the blink of an eye, they lost $50,000. Now, this is for a couple that had to sell. And I do say that long-term investing is the only type of thing that should be done in the share market. So that was a mistake from the beginning, in my opinion. But a lot of people, what happens is when they make their first investment, they put their $50,000 in the stock market, and then within a couple of months, it goes up, it goes down again, and they think, well, this thing's rigged. It's like gambling. And so what I would say to all of you tonight is that the reason that I say to break it up into chunks over time, I had another one of our members write in and say he had $700,000 that he wanted to invest in one ETF straight away. And I said, well, I actually called Vanguard and said, can this be done? And they said no. They prefer not to do that. But basically, the idea is that most people, when they invest, you got to use the regret minimization framework, which is that if I put all of this money in right now and the stock it falls, you'll probably feel terrible. But if you just even broke it in half and you said, I'll put half in now and then half in 6 months, and the stock market falls, you won't feel as bad, because you made a decision that you can still put the other $25,000 in over time. Conversely, if the stock market went up, you probably won't feel as bad as if it fell. And that's what we call the loss aversion bias, where we feel the pain of loss twice as much as the joy of gain. And so for most people, I think it'd be better served just breaking it up into pieces and doing it over time. So anyway, I've prattled on for long enough tonight. Thank you so much for joining us. We've got so many questions. You can reach out to us on social media, hashtag Selfwealth Live. We're all available on social media. And if you have any questions related to your account or to kids investing and those types of things, you can head to selfwealth.com.au, and there's an instant support widget down the bottom. So yes, we'll leave it at this. Thank you everyone for joining us. I can see a great comment there from Anthony that interest rates were practically 0%, so everyone piled into stocks. They did. And it was the worst possible time if you just put your total amount of your wealth in there. So on behalf of Rob and I, thank you for joining us tonight. It was a good chat. And I just think, we are moving through some pretty scary times, but I would like to think that things are getting better. I don't really know. I can't guarantee that, but I would like to think that if you invest in the right way, in great companies and in a diversified ETF, whichever way you want to do it, this year is just as good as last year, in my opinion. In fact, it's probably better because share prices are down. So that's the way I think about it. Thank you for taking the time to chat with us tonight. And we really appreciate it. Have a wonderful night. Enjoy daylight savings if you're on the Eastern Seaboard. If you're out west, good afternoon. Have a wonderful night. And we'll see you next week. On behalf of